What's going on, everybody? Welcome back to my YouTube channel. Now, today I want to talk to you about a very pressing topic, and that is jumping from strategy to strategy. Now, I think this has become a pandemic in the trading industry for the reasons that are understandable. I mean, if you're trading for a very long period of time and your strategy is not working, and then all of a sudden, you glimpse over at social media, you pop over to YouTube and you see somebody posting their wins and their success rate due to their strategy, you're going to be inclined to be a bit curious. And then eventually you're going to be swayed to the other side. But I want to share this concept with you today just to try and really help you to understand that the strategy is not as important as your consistency. Now, I know that sounds a bit contradictory because you need to be consistent with a strategy in order for you to get some sort of success. But at the same time, guys, your consistency on a day-to-day basis is the most important thing. And how I like to approach my trading is from a technical stance. So I don't necessarily trade a strategy. I'm much into trading behavior of the market along with technical analysis. But I want to give you three key concepts that I personally focus on in my trading. It doesn't matter what time frame I'm on, to really help me to be able to identify high probability trading setups, to make me feel comfortable in the markets and give me the confidence and the belief system that I need to show up every day and do the same thing over and over again. So without further ado, let's jump on the charts and let me share these three concepts with you. All right, guys. So the first pair that we're looking at here is Euro USD. Now, it's not the pair that makes the difference here. It is just simply the concept. And when we come to the charts in the morning, we can see that the market is clearly ranging here. Now, we don't have to see that price is ranging today. We could see that price has been tapping into some of these structural lows from this point. We can see it tapping into this point. We can see it tapping into this point here and this point here. Now, when price is failing to break these structural lows and break these structural highs, we have a clear range. Okay. We just need 2 points of contact, two from the bottom, two from the top. And that's exactly what we have. So when we come to the markets, we can see there's no directional bias. Price is neither breaking to the high or breaking to the low. So we don't have a trend here and we don't have any sentiment that is illustrating that it is more bullish than it is bearish or bearish than it is bullish. So once we understand that information, we can start plotting in our levels. Now, this level here is just an indication to us that price is going nowhere. It's failing to break the highs and it's failing to break the lows. Now, the kind of theory that I follow when price is doing this is identifying a lack of behavior in either or direction and then assuming, because everything you do as a trader is an assumption, guys. All right. You trade based on what has happened in the past, and then you execute in the hope that it will do it again. That is what you're doing. So when we see 2 points of contact and we see price not breaking higher than low, then we assume it's a range, and that it is now. So I come to the markets. It's Monday. This is what's happening. I don't trade for whatever reason. I love trading ranges, but I don't trade. Now I come into the markets and it's Tuesday. I can see we're still stuck in the range here. Price is not breaking the highs or the lows. Doesn't matter where price is within this range. I just know it's not breaking the highs or the lows. So the immediate assumption that I'm going to make today on Tuesday is that I'm going to buy from the low and I'm going to sell from the top. Now, I don't want to do anything different because unless price is illustrating that it is doing something different, then I need to do what it's doing. So that being said, I come to the markets, it's ranging. I know I'm buying from the bottom, I'm selling from the top. What I'm doing here, guys, is I'm fixating in my head that I'm only looking for buys from the low and buys from the top. I'm being consistent with my process. Why? Because the concept behind traded ranges is sell from the top, buy from the low. So what can I do when this happens? Well, I'm marking my levels. I come to the markets, let's just say nothing happens for a period of time. Okay, price comes back to the highs. What can I do in a situation like this? Well, I already know in the back of my mind that price is pushing bullish. I also know that we're in a range so that if we don't break the highs, then technically, if we're not going up, we must go down. I'm going to use scaling down techniques. So I might go to the hourly time frame, make sure that I've aligned my levels properly so I can see we had a strong push to the upside here. Price broke out. So we could use this on an hourly, but coming to the charts on a Tuesday, I can see price is starting to react and create levels. Okay, that being said, now I know the rule of thumb. I'm looking for a depletion in that bullish sentiment. I'm looking for a shift in that bearish sentiment. And I can say to myself, well, look, I can see multiple wick rejections. I can see the bullish sentiment coming into the markets. And now I can see price creating a bearish movement to the downside. And I can look to take the trade like this. Now, I want to make this very clear. When I take this trade, I'm taking this trade under the assumption, based on the concept that this is in a range, price is going to react from this resistance level and it's going to go bearish. Now, if I take this trade and it breaks through, then that is the market telling me that there is now a directional bias. The concept of price being stuck in a range, selling from the high, buying from the bottom, is now invalid, and I lose the trade. And that's completely fine. But if I show up again tomorrow and you guys all see it yourself being traders, and there's another range and I take the sell from the high, buy from the bottom, there's a high chance that price is going to react. Not because it's a strategy, because the concept behind a range is when price gets trapped between a high and a low, more often than not, it will bounce from the bottom and react from the highs. That's a consistent process. So all I need to do is hold on to that belief that this concept is valid, and I can make this now my strategy for when I come into the markets. Not that this is a strategy in itself. The strategy that I will use is going to be this in the markets. And as long as I do this over and over and over and over again, when there is a range, there's a very high chance that I'm going to be profitable. Now, the second concept that I want to focus on is trading with the direction of the market. So if you see here now on gold, we have an area in the market where prices failed to break the highs, and we have an area in the market where prices failed to break the lows. Within that, we also have a mini range as well. Now, this being the 4-hour time frame, we can break this down to as many ranges as you want, but that is your choice. But here we have price failing to break the highs, price failing to break the lows. So we sell from the highs, we buy from the lows. Here again, we're failing to break the highs, failing to break the lows. So we sell from the highs, we buy from the lows. Let's say you're not a range-bound trader and you much prefer to trade with the direction of the market. Then the concept you're going to come into the market with is you need a clear directional bias, meaning price should not be reacting to structural highs and structural lows, and instead price must be breaking through these levels in order to initiate a directional bias. So you're sitting here, it's now Wednesday, nothing's happening in the markets, price is ranging. So you're being patient, you're being consistent. We're not developing a strategy here. We just know from past history that when price is trapped between lows and highs, it doesn't break. And if it does break, then there's a higher chance that it will continue in that direction. Again, not every single time. I want to make this clear and make sure you understand this as a disclaimer. But if you are consistent in being patient and disciplined, and you are waiting for these setups to develop, then you take them when they do develop. And it may mean that you're not going to take a trade every single day. There's a very high chance that you're going to become a profitable trader simply because the market likes to repeat itself over and over again. The only difference is with a profitable trader and a non-profitable trader is that a profitable trader is patient enough to wait for their setups to develop and executes without fear or doubt. And a non-profitable trader will just show up to the markets and trade whatever they feel to trade based on the stories or the narratives that they develop in their head. So now, today, being a Wednesday, I don't want to trade ranges because I'm not a range-bound trader. Market is tapping into the highs and lows, so I'm waiting. We step into the market on Thursday. And what happens? Well, you can see here, price finally breaks these structural highs. Now, I trade with the direction of the market. I can see that price is moving higher. We were trapped, but we finally broke above. The concept is if price breaks above a structural high or low, it will continue in that direction. So if you're a breakout trader, you have a very strong breakout, a nice close above this structure, and then you can look to place your stop loss below the breakout candle, wherever you choose to place it. That's a concept in itself, right? If the price breaks out of a structural high or low, it will continue in that direction. And that's exactly what it did. Now, another way you can trade this is you can say to yourself, well, I see the evidence of price moving in a directional bias, and I want to put my stop loss below the area where it broke out of. Because the theory is if price breaks out of the structural high, and it breaks back in, then technically it's not going to continue higher. So I'll just accept the L and I'll move on and wait for another setup. Or you can say to yourself, well, if price breaks above the structural high, then there's a high chance that it will come back to retest that level. And then in theory, it won't break the low and should continue higher. So in an instance like this, you go from having a bigger stop loss to a smaller stop loss, and neither is better than the other. It's just that you continue to remain confident that the directional bias is going bullish. And the only time that this gets invalidated is if it breaks back into the structure and or below the breakout candle. Now, you might say to yourself, well, no, once price breaks out of this high, I want to see confirmation of price retesting this structure because I want to see that price is truly creating a structural high and the higher low point at a retest level. And then I want to look to take the trade when price starts to break these structural highs, however you take this. And then I have an area in the market where I can place my stop loss below the higher low. Now, the reason you want to place it behind a higher low is because if the market is in an uptrend, it makes higher highs and higher lows. And as long as it respects the higher low, then in theory, it should continue in an uptrend. The only time that that uptrend becomes invalidated is when structure breaks the higher low to create a new low, which means that the uptrend is potentially depleting. So it's safe to assume that your stop loss placement here and or waiting for this confirmation of the retest or higher low is a safe option to pick. Neither is better than the other. It's just what you're comfortable with. But the concept still remains the same. We are waiting for a directional bias. We're waiting for price to break out the structural high, and then we're waiting for price to retest. Now, you might say to yourself, well, I'm not happy with that. I want to see price create the retest. I want to see price create the breakout, then the retest, and then I want to see price pushing above the breakout level to make sure that we truly do have direct momentum in our direction. Okay, so you have that. You have a bullish close. Granted, there is a wick rejection there, but whatever the case, let's just assume it's a strong wick rejection. Then you have another opportunity with the same development and concept that you are holding on to be the truth about how you will come to the markets, or the truth as to why you will come to the markets and execute this way every single time. Okay, what we spoke about in our previous video, and that is just understanding the market's behavior. So let's take a look at this. We can see price was in a bullish uptrend. We can see price made a structural high in the market. Price attempted to make a higher low, tried to break and failed, and we had a very strong break back into the structure. Now, this doesn't really mean anything at this stage, because technically we can still use this level and look for a bounce for price to continue higher as a double bottom in an uptrend. But you can see here that price broke through this. So now we're seeing a behavioral shift. Okay, we see the behavioral shift. Now, what we want to see in the market is price continue to develop a trend. Now, again, this is not a strategy. This is a concept based on trading with the trends. If price is making higher highs and higher lows, then technically the market is in an uptrend. If price is making a lower low and lower high, then technically price is in a downtrend. So that being said, if we make the higher low, we failed to make the higher high or just about, and then we break back in to take out the higher low, then technically the market is shifting. But we want more confirmation than that. What we want to see price doing is creating a structural high, a structural low, and a structural lower high. Now, we may not be willing to sell here at this point because we want more confirmation. We want to see that the trend is developing. So what can we do? Well, we can assume that if price breaks the structural low in a downtrend to make a lower low, then in theory, if price continues to come back to this level as a retest, we should continue down if it doesn't break it. And if we make a lower high when price is now starting to illustrate a downtrend, then we can assume that we're in a downtrend. Again, it's just an assumption. Price develops. We listen to what the market's telling us. In the past, that's what it's done. In the future, that's what it will do. Not every single time, but your edge is your risk to reward, your risk management, the fact that you can be disciplined, patient, you can be consistent, you could avoid doing dumb shit. That's your edge. So it doesn't matter if you win or lose, and the actual trade itself shouldn't be the sole focus. It should just be simply the process. And if we're looking at what's developing in the markets here as a concept, it's creating a downtrend. So once I have this information, I can use scaling down techniques. Let's say I want to go to the 15-minute time frame and trade this. I can see that the market is now creating this downtrend. Now, what we're going to do is ignore everything that is above this level here, and we're going to start to draw in an area in the market where we are comfortable to take the trade. Now, these are all wicks on the higher time frame, so you can move these levels, especially if you're trading the 15-minute time frame, to where price meets this point the most, so that if price does not clearly break this level, then you can opt to not trade until you have clear confirmation that price has truly broken this level and then come back to retest it. Now, remember, everything that we're seeing here could be noise, especially if you don't have a trading plan, you don't understand your process, you're not confident about your process. This could all be noise. You could be looking to jump in the markets at any point in time that you choose to do so, because you create those stories and narratives in your head to jump in because of fear of missing out, because of doubt, because of fear, because of whatever it may be. You may just jump into the trade. But the key indicator here is this: anything above the support level was information. You are coming into the markets with the concept that you would trade with a trend. As long as price breaks the lowest point, which is the structural low in the now developed downtrend, and once it's broken, you are then going to look for the lower high to continue that downtrend from the higher time frame perspective. And that point, that low point, is this here. So you can see prices respecting, failing to break. And then finally, we have a clean break. Now, it could break out, it could break back in, it could do whatever it wants. But the point is this: we know that as a concept, we are only looking to trade with the trend once price has broken those higher lows, or those low points and those high points, and come back to retest those points. What does price do? Price comes back to this level and retests it. And then what can you do? Well, then you can look to take a trade and opportunity, however you choose to do it. It doesn't matter. Let's say you take this trade. This is what it would look like. If price comes back, let's say it stops you out. Okay, whoop-de-doo. We take a loss. Has the concept changed? Has the principles changed? Has the behavior changed? No. Price comes back. You get stopped out by spreads. I doubt it. But let's say we see price reaction from this level again. But what can we do? We take another trade. Are we over trading? Are we revenge trading? Are we doing anything that we shouldn't be doing? No, we're following through with our trading plan. We understand our concept, we're identifying the behavior, and we're executing based on that. It is simple. So these are the three concepts that I use, guys. I'm looking to trade based in ranges: price, sell from the highs, sell from the buy from the lows. If price is not in a clear, doesn't have a clear directional bias, then I'm waiting for a clear directional bias, price to break out, retest, whatever it may be. And then if I'm not a range bound trader, I'm not looking for breakouts, I'm looking for clear trends, then this is what I'm doing. I'm looking for clear trends and waiting for price to break the lows or highs and look for retests in and around the breakout point so I can have a safe stop loss and then executing those trades. And it's a very simple way to approach the market. You do not need to make it complicated. If you go onto the charts, you're going to see it everywhere for yourself. The market does these three things every single day on every single time frame. You just got to make sure that you understand this to be true. You got to accept that as a fact or a belief, a strong belief, not a fact. It is a fact that it happens, but it's not a fact that it will happen all the time. But you got to accept that as a strong belief. You got to hold on to it, guys. You got to marinate in it. And then when you see those setups develop, you got to execute without fear. This is not a strategy. These are not strategies. I'm not telling you how to trade. I'm just telling you how to think about the process. And once you have a consistent way of thinking, then you're going to become so much more comfortable with your trading. It's going to take time. It's going to need experience. You're going to have to take a lot of L's in order to get to a stage where you're comfortable. But the quicker you're able to accept those losses, then the quicker you're going to get results. And I don't mean this is a sprint. This is 100% a marathon. But it's better that you slowly and incrementally build on your results than it is to try and chase a pass this month on a challenge, get funded next month on a challenge, and then end up losing your funded account the month after. Slow and steady wins the race. But in order to continue on this journey and on this race, guys, you've got to have a concept that you truly believe in. Think about the principles. Think about the elements that you need in order to make the decisions to make your trade, because the process is more important than the result of the trade itself. Anyway, guys, I hope this was helpful. If you enjoyed this video, make sure you hit that like button, subscribe, turn on notifications. And as I always say, until next time, continue to trust the process.